Good afternoon, everyone. My name is Adriana Calderon. I'm the transfer pricing leader for Transfer Pricing Solutions Asia, a boutique firm that specializes in transfer pricing services located in Singapore, Malaysia, and Australia. And today I'm going to be talking to you about key features of transfer pricing regulations in Asia. Before I start going into the detail, I would like to introduce our firm. So Transfer Pricing Solutions is a boutique firm that specializes in providing practical, proactive, and cost-effective transfer pricing advice. We have more than 25 years of experience in providing transfer pricing advisory services around the world. With three partners, one located in Australia, me, who is located in Singapore, and also Malaysia, with a flexible team that has the capability to speak English, Mandarin, Hindi, and Spanish. So our main key differentiation to other transfer pricing providers, we call it the 6-point guarantee shield. Shield stands for security, high quality, integrity, execution, leaders, and directors. Security means that all the information that is shared with our firm is kept to the highest standard of security in data and privacy and confidentiality. We are an Australian head office and a regional head office in Singapore, so we follow Australia and Singapore values. We have a high quality team that is basically all our consultants have at a minimum 5 years of experience or more in transfer pricing advisory, so dedicated transfer pricing advisory. Our team is not landing on the job at the expense of our clients. We offer integrity, and what it means is that in every quote that we release is final with not add-on or hidden cost. We promise a seamless execution, and what that means is basically that we execute every project within the timeline given to the client with no excuses, no derails, and no delays. All our directors are top leaders, and what it means is that we have been really training the industry both in Australia, Singapore, and Malaysia, training accountants, training CFOs, tax managers, and even the tax authorities in the area of transfer pricing. We love what we do, and we really love sharing what we know with the industry. And our last and sixth point is D for directors. What it means is that our directors will be always involved in every project and available to all of our clients. So with that, let me just start with the topic for today. We will talk about three key important aspects of transfer pricing. Aspect number one is transfer pricing framework in Asia. Aspect number two is the importance of transfer pricing documentation. And aspect number three, or topic number three, is the top tips to mitigate transfer pricing risks in Asia. So let's start with the transfer pricing framework in the region. So the transfer, why, and this response or answers one question that we commonly get asked: why do multinational companies have to manage transfer pricing, and why managing transfer pricing is key? Well, the reality of it is that almost all countries have implemented transfer pricing legislation in Asia. Unless you're planning to go and live in one of those remote areas, I think it's really hard for multinationals to escape the transfer pricing legislation. And even small countries like Laos, Cambodia, they are all catching up in implementing transfer pricing legislation. So worldwide, majority of countries and in the region already have implemented transfer pricing legislation. So it is also now an obligation for taxpayers, and definitely during the past 7 years, the compliance obligations related to transfer pricing have increased. So in today's world, we have different compliance requirements, such as forms disclosing related party transactions and different forms of transfer pricing documentation, from country by country reporting, master file, or local file. A third key issue and key point is that tax authorities have more visibility over the related party transactions and transfer pricing positions, because in every country, taxpayers have new reporting requirements, from country by country reporting to reporting forms to disclose the values of controlled transactions entered by the taxpayer. And the last but not least, tax authorities are actively sharing information. There is a multilateral instrument that has been released by many countries and implemented by many countries to actively share information. So what are the key compliance requirements? And I think in Asia, we can summarize the compliance requirements in two forms. Number one is the tax return forms that every taxpayer has to prepare to disclose the related party transaction information as part of the tax return. So we have it in Malaysia, we have it in Singapore, which is called the related party form. We have it in Vietnam, we have it in Australia. So it's a dedicated form within the tax return that discloses information about the related party transactions entered by the taxpayer during the year. And the second big requirement is the three-tiered approach for TP documentation. That includes having to prepare either master file, local file, country by country reporting, or other local documents depending on the country. So what is the impact of this three-tiered approach? Well, what it means is that if a global multinational group has global revenue greater than 750 million euros, or the equivalent in local currency, that multinational group will have to worry about three key things: country by country reporting, master file, and local file. If the global multinational enterprise or company has global revenue for less than 750 million euro, or the equivalent in local currency, the chances are that it has to at least look into preparing a master file and a local file. Each country has adopted their own interpretation and requirements, and they are really increasing the compliance burden for clients. So we have examples like Vietnam, Indonesia, and China that, apart from the related party forms and the three-tiered approach TP documentation, they have implemented different type of reporting forms that the taxpayers need to implement. So what is the reason, or what is the theory behind the three-tiered approach? So the objective of the three-tiered approach was basically to have a more holistic way towards preparing transfer pricing documentation and analysis. And holistic means that every tax authority will like to know more about both the local taxpayer and also about the global operations. So that's why in 2015, the OECD released the three-tiered approach to preparing transfer pricing documentation. And what that means is basically that the idea is that the global parent entity will prepare the country by country reporting, local file and master file, and exchange via the tax authority parent entity with the tax authority of the subsidiary, at least the CBC report. And the idea is basically that the global parent entity at a bare minimum will take care of country by country reporting, master file, and some form of local file, and exchange this country by country report with tax authority or the foreign subsidiary. From the foreign subsidiary point of view, what it really meant is that the country-by-country reporting was or is going to be exchanged by the tax authority, by the competent authority. And basically, the subsidiary of the multinational group will have to provide in the local country either the local file or the master file, or both, depending on the regulations. But as you all know, these have had different approaches and different implementations in each of the countries. So in some of the countries, the accepted approach is that the global parent company will prepare all the country-by-country reporting, local file, master file, will provide the local file and master file to the foreign subsidiary, and will exchange the country-by-country report with the tax authority of the parent entity and exchange it with the tax authority subsidiary. So in other words, the subsidiary will only be responsible to provide to the tax authority at a bare minimum the local file and the master file. So that's why it's really important to make sure that if you are a foreign subsidiary or you are a regional entity with global revenues more than 750 million, that you have to, at a minimum, prepare country-by-country reporting, master file, and local file. If your global revenue is not 750 million or equivalent in local currency, you at least have to look into local file and master file for Singapore and all of the other subsidiaries in the region, because all countries in the region have implemented already the three-tiered approach to transfer pricing. So I guess some of the key tips and key questions that you as a regional head or as a regional finance manager or tax manager in charge of the regional documentation, you need to ask yourself is, where do you have to comply? So which countries have safe harbor threshold for compliance? And where do you have to start getting ready to comply and to prepare TP documentation? Whether does my company exceeds the threshold? And then if the answer is yes, then I will probably have to start looking at preparing TP and documentation. And the second question is, what do I have to prepare? Do I have to complete the tax return forms? Do I have to complete CBC reporting, country by country reporting? Do I have to prepare master file? Do I have to prepare local file? And do I have to prepare any other forms in the local country? For example, Australia has something called the Australian local file form, which is different to a local file. And it includes some disclosures about the business, and it adds up to the compliance requirements. So what is the importance of transfer pricing documentation? I guess, and the most critical reason why transfer pricing documentation is important is because it's mandatory in most countries in the region. Even if it's not mandatory for the regional head office in Singapore, the chances are that the regional head office in Singapore will get caught in another jurisdiction for the need of preparing documentation, because even though Singapore may have thresholds to prepare documentation, those thresholds are not applicable overseas. So it's critical that some form of documentation is prepared. If it's not for Singapore purposes, it could be for other countries. And that brings us to the second point, which is that transfer pricing documentation is really critical to demonstrate compliance with the arm's length principle. So again, Singapore has this peculiarity whereby we have mandatory documentation for certain taxpayers, but the arm's length principle is a requirement for all taxpayers located in Singapore. And that's where it becomes very critical for a company that has responsibilities not only for Singapore, but for the region, to prepare the documentation and ensure compliance with the arm's length principle, because it will be required for Singapore or for other countries. It is also seen as a risk mitigation and assurance, similar to an insurance policy, to ensure that we In the event of an audit and adjustment, the taxpayer can defend their position. And last but not least, TP documentation is seen as a good practice by tax authorities and is an audit defense mechanism too. So I have heard from our clients stories whereby the fact that they have explained to the tax authorities that they have documentation, that they have contracts in place, and that they have thought about transfer pricing is sometimes a step towards not having a TP adjustment, because it gives the tax authority the reassurance that the client is having good governance and is having good processes to ensure compliance with the arm's length principle, and that the client or the multinational is thinking about the arm's length principle and how to be compliant. So it's a perception also, and with the tax authorities to show that the taxpayer has thought about it. When are taxpayers expected to prepare documentation? So documentation should be contemporaneous to the related party transaction. In an ideal world, the documentation should be prepared prior or at the time of entering in the transaction. But in any case, not later than at the time of completing and filing the tax return for the financial year in which the transaction takes place. Majority of tax authorities consider contemporaneous documentation the documentation that is prepared at the time of entering into a related party transaction, or at the latest at the time of completing the tax return. A typical question that we also get asked is, how often does a taxpayer has to prepare TP documentation? Most countries every year as a minimum and update the financial data of the comparable companies. If there are changes to the business model or transaction, they will also need to be documented. So for example, any impacts now due to COVID-19 that can impact prices, that has to be documented and updated in the TP documentation. Comparable searches, as a standard practice, it needs to be prepared every 3 years and updated every year. One, because TP documentation supports the tax return and the taxable position of the taxpayer for the basis period in which the taxpayer entered into the transaction. That's why most tax authorities require taxpayers to update as a minimum the financial data and the documentation to ensure that they are monitoring the pricing and adherence with the arm's length principle every year. So what type, a typical question also that we get asked is, what type of comparable companies are accepted? Most countries in the region prefer local comparables. Some countries are willing to accept regional comparables if local comparables are not acceptable, but this has to be demonstrated. So Singapore is one of the few countries that accept regional comparables, but the taxpayer needs to demonstrate that it looked first into local comparables and local comparables were not available. Some countries already have local database and preferences. So India and Malaysia are good examples of countries that require specific local comparables and are not willing to compromise or non-local comparables. Another question that we get asked very frequently is, okay, so if I have to prepare documentation for not only Singapore, but the region, what is the best approach to take? Do I centralize or decentralize the TP documentation? So centralized TP documentation is where the parent company manages and controls the process, followed by the BEPS ThreeTiered approach, and it basically manages the master file, local files, and CBC reporter. The good thing about centralization is that it allows consistency globally. And this is important due to the exchange of information between tax authorities. So a lot of our clients that we speak, they are very concerned about consistency. And if their priority is to be consistent across the globe, then it makes sense to centralize the documentation. Some of the challenges that can arise is collating of information from all the subsidiaries. The subsidiaries have the duty to ensure that they are also covered and that local documentation really addresses the local requirements. And subsidiaries may still have to localize the documentation and translations. So the centralized approach can be done from Singapore. It requires at a bare minimum a centralized approach of the core documentation and potentially reviews with local advisors to get reassurance on translations and reviews. So that's one way of approaching the TP documentation. Another way is the centralized documentation, where the parent company and subsidiaries share the control and management of documentation. Some of the challenges include inconsistent information between the parent company and subsidiaries around the world. It could be a one-side documentation that doesn't consider the other country. And I think, in my view, is not suitable for multinational companies that require country-by-country reporting. So in a nutshell, the centralized documentation can also be done whereby the parent company and the subsidiary takes control of doing the local documentation. But there has to be an element of reviews, whether it is the regional reviewing all the documentation and making sure that gives sign off on the local documentation, particularly to ensure the consistency. The last thing you want is to be saying one thing in one country and saying another thing in another country. So this first challenge of inconsistency is a critical one to address if you decide to look at decentralized documentation. And finally, what are my top tips to manage transfer pricing risks in Asia, considering that in every country we already have transfer pricing documentation? Well, there are in transfer pricing the very broad common issues. And the two key issues broadly in any business model, in my experience, and in any transaction, it is two main issues that come down to either substance or pricing. So every single transfer pricing analysis need to ensure that it addresses both key issues, substance and pricing. So what are some of the most common transfer pricing risks that can come either under substance or under pricing? So risk number one is the structures or transactions with lack of substance. And this is probably one of the most difficult challenges because it doesn't have a quick fix, as it is not possible to create substance with transfer pricing documentation. Why? Because profits should be taxed where value is created, and ensuring the matching between substance and form with a robust functional analysis is critical. So if you have a situation of lack of substance, which is a very aggressive lack of substance position, I really suggest that you start looking into it, because lack of substance, I will say, is the number one transfer pricing risk that is not very easy to fix because it requires a total change in the transaction and business model. Risk number two is incorrect pricing or pricing that is not supporting with benchmarking. So I think incorrect pricing comes down to not having a benchmarking that supports or not having a strong comparability analysis and a strong data to support your pricing. That's why, if possible, support each of the prices with a benchmarking, whether it is with internal data or external data, before filing the tax return, to support that there is some basis to the prices in the transaction and minimize the risk of an adjustment under the argument that the price was not tested or the price was not supported with any market data. Risk number three is changes in pricing as a result of a TP analysis. So the TP risk of previous years not being correct, or prices not being correct, has happened before the analysis. So what could happen here is that there is a particular price for a transaction, and that transaction was never tested, and that price keeps being incorrect year after year after year. That is a really hard management or risk to manage, because what it means is there is a tax liability building up year after year after year, and in most cases companies can only amend in the future, especially if there was not contemporaneous documentation. It is really hard to amend past years. So that's why it is very important to have some basis for the price since the beginning. Otherwise, you can build a liability over and over and over again. We had a situation where there was a subsidiary in Malaysia that was overpaying tax since 2014 due to mispricing between Singapore and Australia and Malaysia, and that price kept building up year after year. Now, when we came in to advise, we realized that the price was incorrect, and there was a clear overpaying of profits and tax in Malaysia. And now in the fourth year, we had to correct it. So that creates a lot of issues, because then it creates the fact that you have to change the price and you have to amend those prices going forward. It triggers the potential review from the tax authority, and then you have to explain to the tax authority why the price was incorrect and why the current price is correct. And that becomes really a judgment call and a negotiation with the tax authority. So that's why it's very important and critical that if the multinational group can afford to have the price since the beginning correctly, to have it correctly. Another typical transfer pricing risk is recurrent loss makers. When there is a recurring loss entity, there has to be a very clear explanation on how the losses arrive and what is the main commercial driver of those losses, because obviously tax authorities do not like recurring loss makers, meaning by more than 3 years. So that's always a reason or a trigger in our experience for an audit and a review from tax authority. So if you have situations of loss makers in different countries, that's something that you need to address and ensure that there is a robust explanation to minimize the risk of a transfer pricing adjustment. Another typical risk is the challenge between the usage of local versus regional comparables. In most countries in Southeast Asia, local comparables and Asia in general are the preferred approach. Regional comparables may be acceptable, but it's key to show that local comparables were not found. And there are countries that they are very clear about not accepting regional comparables, like Malaysia and India. Another typical risk is, okay, if I am doing transfer pricing planning, what point in the arm's length range is acceptable? And the way in which taxpayer can manage that is to stick as much as possible with the median point. And if there is deviations from the median point, they need to be explained. And last but not least is basically the biggest transfer pricing dilemma, which is a pricing that suits two countries. And for that, that's why it's so important to have a benchmarking before filing the tax return, because with market data and analysis, whether it is doing an external search or with internal data, that will be the best basis and the best way to show that the price is an arm's length and that is supportable in two countries. So that's pretty much what I wanted to cover today. If you have any questions or you want to get in touch with us, we can help you with your regional matters and transfer pricing issues. We can help you with transfer pricing documentation in Singapore and the region. We are located in Singapore in 8 Marina View. Follow us in our social media, where we a lot of the times share valuable information and blogs about not only about Singapore, but about the region. We do have capability to prepare regional transfer pricing documentations and perform regional, global, and local benchmarking. So do get in touch with us, because we can definitely assist with your regional transfer pricing documentation needs. Thank you. Bye.